More and more Americans are buckling under the weight of mounting credit card debt. Inflation, as well as strong consumer spending, has sent credit card balances ballooning in the U.S., reaching an astounding record high of $1.3 trillion. Now, looking at the data, over the past 2 years, Americans' credit card balances have skyrocketed by 40%, and this explosion of debt will hold severe consequences for the economy as a whole. In November alone, balances had spiked 18%, and the number of people carrying balances from month to month has increased by 49%. In fact, only a third of balances right now are being paid in full, which is the lowest amount in 4 years, and 56 million Americans have been in credit card debt for at least a year. To make matters worse, all stages of credit card delinquencies, from 30 to 60 and 90 days past due, have jumped higher during the third quarter of last year, close to setting a record since the data started being collected in 2012. Delinquencies are occurring as debt is getting drastically more expensive, and carrying a balance is worsened by sky-high APRs, which is making debt a deeper and deeper hole to climb out of. And the average credit card rate is actually above 20% right now. And so the overwhelming effect of debt is feeding into the negative outlook Americans have on the economy, despite the White House telling us how well the country is doing. And with inflation, people are being forced to rack up debt for practical purchases such as food, fuel, and necessary day-to-day expenditures, and bills are becoming much harder to pay in the face of stubborn inflation, burned-up stimulus savings, and renewed student loan payments. Banks are also making it much harder to get credit in response to delinquencies, and they're granting fewer credit line increases and actually reducing credit lines much more frequently. Now, this boost in consumer spending is about 70% of the U.S. economy, which can be fine when things are going well, but in the face of rising debt and credit issues, this short-term boost can actually become a drag over time. See, as individuals falter in repaying their debts, creditors, including banks, will bear the brunt of that. The surge in defaults would translate into losses for the creditors and lead to a decline in profitability, potentially threatening the stability of the financial institutions. And as a response, these institutions may further restrict their lending practices, leading to a deeper and much more severe future recession. Investors that are holding securities backed by consumer debt may be in for a major shock, as asset-backed securities form a significant portion of investment portfolios. A surge in defaults would translate into significant losses for investors in the stock market. And the potential for massive credit card defaults presents a very clear financial danger. Ballooning consumer debt could set the economy up for a crash. With overwhelmed Americans left with nothing to spend, businesses would decline, and financial institutions could be left holding trillions of dollars in bad debt. Any government intervention would make the problem worse. See, stricter lending requirements would suffocate growth. Cutting rates would reignite inflation, and actually raising those rates could put the final nail in the coffin for indebted America. And that's why experts are suggesting to look into physical gold and silver as a hedge against the consequences of runaway debt. With intrinsic value and no counterparty risk, physical precious metals as part of your portfolio or a gold IRA can protect the value of your retirement funds. And if you're concerned about where things seem to be headed in this economy, I'm Makai Block with American Hartford Gold. Give us a call today and we'll discuss how putting physical precious metals into your portfolio can actually get you the protection that you need.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.